This is a model of the profit equation that we've just derived. Estimated profit is equal to the assumed asset change plus the measured cash flow. And what we've done is to combine revenue and costs into a single pipe for estimated profit, combined all the non-cash assets and liabilities into a single tank called assumed assets, so the receivables, the payables, and the inventory. And then finally, receipts and payments have been combined into a single pipe for measured cash flow. So let's look at two scenarios. The first one, where measured cash flow is larger than estimated profit. So in this scenario, we can see the business is generating a profit, there's a credit balance in its profit and loss account, and it's getting more cash in. So perhaps it's receiving cash in advance for a service that it hasn't yet provided. And the net result is that there's a liability on its balance sheet. But the business gets the cash in quickly, and this is generally a pretty good way to operate. Instead, let's look at what happens if measured cash flow, for example, is negative and estimated profit is positive. So again, we can see the business is making a profit, but its cash flow is negative. So essentially, it's got this large assumed asset on its balance sheet. And the danger here is that actually this assumed asset may not turn out to exist, or its value may be much smaller than was previously anticipated. And what effect will that have? Well, that will alter the profit. So whereas the business thinks it's making a profit, in fact, it may have just been making a loss. And this is the fundamental cause of corporate scandals such as the Enron scandal and the financial crisis.